Every month, the federal government releases a document called the Advanced Monthly Sales for Retail and Food Services. It is a dry, spreadsheet-heavy report that usually puts economists to sleep. But recently, a single print sent a shudder through corporate boardrooms from Bentonville to Seattle. US retail sales did not just tick down, they plunged by the sharpest margin in nearly 2 years. For 3 years, Wall Street analysts and financial commentators have repeated a single, comforting mantra like a religious catechism. The American consumer is resilient. We were told that no matter how high interest rates climbed, no matter how stubborn inflation remained, the ordinary citizen would keep swiping their plastic, keeping the entire global economic engine humming out of sheer stubborn momentum. That illusion just shattered. The resilient consumer did not just slow down, they pulled back with a sudden calculated violence. But if you look closely at the landscape of American commerce right now, you realize this single macroeconomic data point is not an isolated bad month. It is the visible crest of a massive underwater tectonic shift that the retail industry is desperately trying to minimize. Something fundamental is breaking in the way Americans buy things, and the people running the country's largest corporations are quietly panicking. This is not the standard retail apocalypse narrative you have been hearing about since the rise of early e-commerce. This is not just about old, mismanaged department stores finally succumbing to their debts. We are witnessing a quiet, systematic dismantling of the physical infrastructure of American life. Stores that have anchored suburban strip malls for 30 years are disappearing over a weekend. Shelves are being liquidated without fanfare. And windows are being boarded up under the cover of routine corporate restructuring language. The paradox at the heart of this collapse is what should terrify anyone holding an investment portfolio or a retail job. We are told the labor market is stable, that unemployment is technically low, and that wages have kept pace with corporate pricing. Yet the data shows a different reality. The engine has run out of fuel. For the past 24 months, the appearance of consumer strength was not driven by real economic health, it was sustained by an unprecedented explosion of shadow debt. When traditional credit cards maxed out, tens of millions of Americans turned to buy now, pay later services to finance everything from winter coats to routine grocery runs. It was a massive, unregulated experiment in short-term leverage that masked a profound decay in purchasing power. Now, those microloans are coming due, delinquency rates are quietly creeping to heights not seen since the Great Financial Crisis. And the consumer has hit a hard psychological wall. The scale of what is happening right now goes far beyond a temporary dip in corporate earnings. It is changing the literal geography of our communities. When a major retail anchor closes, it triggers a mathematical domino effect. The foot traffic that sustained the neighboring dry cleaner, the local pizza parlor, and the boutique nail salon vanishes overnight. The commercial real estate market, already reeling from the permanent shift toward remote work, is now facing a second wave of vacancies that many regional banks are fundamentally unprepared to absorb. We are looking at the creation of commercial deserts, entire suburban corridors where the lights are turning off permanently. Yet, the most alarming part of this structural retreat is not the companies filing for bankruptcy. It is the actions of the apex predators. If you look at the headlines, you see names like Party City, Bed Bath & Beyond, or Tuesday Morning fading away, which can easily be blamed on poor management or shifting trends. But how do you explain the fact that Walmart is quietly shedding locations? How do you explain Target executing sudden retreats from major urban markets, or CVS and Walgreens systematically erasing thousands of pharmacies from the map? Most baffling of all, why is Amazon the undisputed king of digital commerce? The entity that spent 2 decades breaking physical retail, currently shuttering its own brick-and-mortar experiments and abandoning millions of square feet of real estate, the industry wants you to believe this is just optimization. They want you to think it is a routine pruning of underperforming assets in a digital age. It is an explanation designed to keep investors calm and stock prices stable. But the sheer velocity of the store closures across every single tier of the retail spectrum suggests something far more sinister. The algorithms driving these massive corporations have seen something in the consumer data that has not yet fully registered in the official government metrics. They are preparing for a prolonged economic winter by burning their own outposts to save the core. To understand exactly how deep this trap goes, and why the place where you buy your groceries, your clothes, and your medicine might not exist in 12 months, we have to look past the corporate press releases. We have to examine the 12 specific corporate giants leading this historic retreat, because the hidden mechanisms behind their specific collapses reveal an uncomfortable truth about where the American economy is actually heading. To fully comprehend the speed of the current retail contraction, the historical timeline must be stripped of its corporate marketing spin. The crisis of 2026 is not an unpredicted black swan event. It is the mathematical consequence of a 30-year real estate bubble, aggressive private equity engineering, and fatal miscalculations regarding supply chains. The geographic and economic framework of American retail was built on an unsustainable premise that physical space could expand infinitely without a structural correction. Between 1970 and 2015, the total square footage of retail space in the United States grew by more than 400%. By the end of that expansion, the country possessed approximately 23 square feet of retail space per capita. For comparison, Canada holds roughly 16 square feet per person, while the United Kingdom and France operate on less than 5 square feet per person. This massive overbuilding created a geographical trap. Municipalities eager for property tax revenue routinely zoned vast swaths of suburban land for commercial use. Developers responded by constructing repetitive strip malls and regional shopping centers, anchoring them with major department stores or specialty chains. The entire model relied on cheap debt, rising suburban populations, and stable energy prices that guaranteed consumers would drive long distances to browse shelves. When the economic fundamentals shifted, these properties transformed from cash-generating assets into massive fixed-cost liabilities. The financial architecture of these companies could not handle the friction. The vulnerability was weaponized during the late 2000s and 2010s by corporate raiders and private equity firms. Retailers with substantial real estate holdings or steady cash flows became prime targets for leverage buyouts. In a standard leverage buyout, an investment firm acquires a company by borrowing the purchase price against the assets of the target company itself. The debt is then transferred directly onto the retailer's balance sheet. This financial maneuver structurally crippled companies like Party City, Bed Bath & Beyond, and Toys R Us long before e-commerce reached its current dominance. Instead of investing capital into digital infrastructure, supply chain automation, or store maintenance, these retailers were forced to divert billions of dollars annually toward paying down high-interest debt. Consider the mechanical breakdown of Bed Bath & Beyond's descent, which serves as a blueprint for the failures observed in 2026. The company's historical strength lay in its massive, chaotic inventory selection and its ubiquitous 20% discount mailer coupons. This coupon strategy was highly effective for generating immediate foot traffic, but it created an operational trap. Over 3 decades, the company systematically trained the American consumer to refuse to purchase items at standard retail margins. The coupon ceased to be a promotional mechanism; it became the baseline price. When a new executive management team took control in 2019, they attempted to dismantle this system overnight. The strategy involved eliminating major national brands that consumers trusted and replacing them with high-margin, private label goods manufactured specifically for Bed Bath & Beyond. Management also aggressively reduced the distribution of the iconic coupons to salvage profit margins. The reaction from the consumer base was immediate and catastrophic. Foot traffic plunged and inventories of unrecognized private label housewares piled up in warehouses. To compound the error, the company spent over $1 billion on stock buybacks between 2020 and 2022 in an attempt to support its share price, depleting its cash reserve precisely when operational liquidity was required. By the time bankruptcy became unavoidable in April 2023, the operational architecture was too decayed to attract a buyer for the physical assets, a parallel structural flaw doomed Tuesday morning. Operating in the off-price closeout sector, the company relied on an erratic, changing inventory that turned shopping into a physical treasure hunt. The model functioned efficiently when major manufacturers possessed excess inventory that they needed to liquidate rapidly for cash. However, the supply chain disruptions that began in 2020 forced manufacturers to overhaul their production algorithms. Companies adopted precise data tracking to implement just-in-time manufacturing protocols, drastically reducing the volume of surplus goods entering the market. Tuesday morning suddenly found itself competing with massive, well-capitalized entities like TJX Companies and Ross Stores for a shrinking pool of closeout merchandise. Compounding this product scarcity was Tuesday morning's real estate portfolio. The company was locked into long-term leases in older secondary strip centers that suffered from terminal declines in overall consumer traffic. Unlike its larger competitors, Tuesday morning lacked the capital to renegotiate these lease structures or migrate to dominant premier retail corridors. When the company filed for its final bankruptcy protection in February 2023, it was trapped between inflating inventory acquisition costs and falling sales volumes. Resulting in the total liquidation of its remaining store footprint by the end of that summer, the department store sector suffered from a different geographic vulnerability: its absolute dependence on the health of the enclosed shopping mall. The decline of Macy's is directly correlated with the collapse of the B-tier and C-tier regional malls across the American interior. Built as mutually dependent ecosystems, department stores served as anchors designed to draw consumers who would then spill over into the smaller inline specialty tenants. The mall developers frequently gave anchors deeply discounted lease rates or sold them the land outright just to secure their presence. As digital alternatives eroded mall traffic, this codependent relationship inverted. When inline tenants closed due to falling sales, the mall experience degraded, which in turn reduced the foot traffic entering the anchor stores. Macy's leadership realized that maintaining a massive multi-level physical footprint in a declining suburban mall was a net negative financial proposition. The company's major restructuring announcement, which accelerated through 2024 and 2025, involves closing approximately 150 of these mall-based locations. The strategy is a stark admission that the traditional American department store model, which dominated the 20th century retail landscape, cannot survive within its original geographic format. The historical trajectory of these closures proves that the current retail contraction is not an overnight phenomenon driven purely by a sudden drop in monthly spending data. The foundation for this retreat was laid over decades of financial overleverage, real estate speculation, and a refusal to acknowledge that the domestic market was fundamentally oversaturated with physical stores. The sudden pullback in consumer spending observed in the recent federal reports did not create these corporate vulnerabilities, it merely acted as the final catalyst, forcing overextended corporations to accelerate their exit strategies from the physical landscape. The contraction of the physical retail network has entered a critical operational phase marked by a sharp clash between corporate cost rationalization and community infrastructure requirements. The current breakdown is most visible within the essential goods and pharmaceutical sectors. The complete liquidation of Rite Aid, which concluded its operations by shuttering its final stores, illustrates the systemic vulnerabilities of the retail pharmacy model. Rite Aid originally emerged from its initial Chapter 11 proceedings with $2 billion in debt eliminated. Yet the company collapsed into a second bankruptcy filing within months due to an acute liquidity crisis. This sequence, commonly referred to in financial restructuring as a Chapter 22 scenario, resulted from restrictive credit terms imposed by wholesale drug suppliers and a dramatic decrease in high-margin front-end store merchandise sales. Oasis.com. The immediate operational consequence of these pharmacy closures is the acceleration of healthcare deserts across rural and urban corridors. The corporate consolidation strategies executed by CVS Health and Walgreens Boots Alliance have exacerbated this geographical imbalance. CVS Health implemented a structured multi-year program to eliminate approximately 900 locations, targeting urban zones where aggressive expansion during the previous decade created internal retail redundancy. However, the data reveals that the closure matrix frequently leaves lower-income neighborhoods entirely devoid of pharmaceutical access. The conflict centers on a structural margin compression forced by pharmacy benefit managers. These intermediaries systematically reduce the reimbursement rates paid to pharmacies for prescription medications, rendering independent and non-consolidated physical locations financially unviable. Front-end retail sales, which previously offset thin prescription margins, have experienced a persistent volume decline as fixed-income consumers migrate to discount alternatives or eliminate discretionary purchases entirely. 11fla.com. This structural shift has simultaneously dismantled the off-price and value retail landscape, which was previously considered insulated from e-commerce disruption. Big Lots represented the primary asset in this category, operating over 1,300 stores. The company filed for Chapter 11 protection following sustained inventory imbalances and a severe contraction in spending by its core lower-income demographic. The planned reorganization and asset sale collapsed when the primary stalking horse bidder withdrew from the transaction, forcing the estate into an orderly liquidation managed by liquidation specialists. The corporate structure subsequently converted into a Chapter 7 bankruptcy proceeding, liquidating the remaining real estate obligations. The operational failure of Big Lots demonstrates that inflation has fundamentally altered the opportunistic sourcing model. As supply chains stabilized, major manufacturers tightened production to prevent inventory surpluses, eliminating the cheap closeout lots that Big Lots relied upon to attract budget-conscious consumers. 11flo.com. In the specialty apparel and footwear sector, the structural retreat is driven by an explicit shift in corporate distribution architecture. Foot Locker's execution of its broad restructuring program serves as the definitive case study for mall-based retail exit strategies. The company targeted approximately 400 underperforming mall locations for permanent closure, shifting its capital allocation toward larger off-mall community formats. The friction in this sector is a direct result of the direct-to-consumer initiative championed by dominant athletic brands, particularly Nike. For decades, specialty retailers maintained a competitive moat through exclusive wholesale allocation agreements. As dominant manufacturing brands built their own digital commerce applications and proprietary flagship stores, they reduced the inventory volume allocated to multi-brand wholesale partners. Foot Locker found itself operating expensive, high-rent mall footprints with diminishing access to the exclusive high-margin products that historically generated consumer foot traffic. Simultaneously, mid-tier department stores are trapped in an identity crisis that physical downsizing has failed to resolve. Kohl's has avoided a singular comprehensive bankruptcy filing, but the corporation has managed a continuous series of rolling store closures alongside persistent declines in same-store sales volumes. The data indicates that the mid-market position has become structurally indefensible. Kohl's is exposed to intense price competition from mass merchants like Walmart on the lower end, while failing to match the trend-driven product differentiation achieved by Target. The corporate initiative to embed Sephora boutiques within Kohl's locations succeeded in generating localized traffic increases, but it has failed to arrest the broader decay of the core apparel and home goods business. The operational reality of these contractions has triggered a major confrontation between corporate leadership and municipal authorities. Local governments are experiencing immediate fiscal deficits as commercial property tax assessments plummet and retail sales tax revenues dry up. When a major anchor vacant space remains unleased for more than 12 months, Municipal zoning boards are frequently forced to rezone commercial corridors for industrial logistics use, permanently altering the suburban landscape. The analytical tension lies in the fact that these corporations are not contracting due to temporary operational errors.